All right, welcome back to the End Asset Channel. It's Alden Armstrong here. I'm the head of product and case design here at Better Wealth. Today, I've got some exciting news for you. We got a YouTube debut for Demetrius Walker jumping on the channel with us today. Demetrius is our head of sales, an incredible person, and where he really excels, and the reason he's in the position that he's in, is he's incredible at asking extremely good questions and simplifying very complex topics. As you guys know, when I get on the channel, things get a little bit complicated, and I do my best to bring it to a level that's easy to comprehend. Demetrius here today. We're going to be talking about term insurance and how it's blended in with whole life to give us the ability to overfund these contracts. So, Demetrius, welcome to the channel.
Hey, dude, thank you for the introduction. That was incredible. I'm happy to be here. I'm happy to get into the conversation that we're talking about today as well, because it is fun to hear you go deep into the weeds, and at the same time, it's like, well, let's bring it back to a little bit of a simpler level here. And so I know you did some videos in the past with Caleb, probably with Dom as well, but it was on some of the different carriers that we're working with. So whether that's Lafayette Live, Penn Mutual, Guardian, One America, you did videos on all of them, very deep dive. One of the similarities of all those videos is the fact that there is a term writer incorporated in all of them. And here's the thing that I realize is that, like, as people watch these videos and you're going in depth, like, it's first of all incredibly helpful. And at the same time, it's like, well, are they all exactly the same? And then at the same time, I'll also think about the fact that there is somewhat of a paradox, I almost want to call it, because it's like we put in term writers for pretty much the same reason, but at the same time, all term writers are not created equal. And that's what I would love to have you kind of start to go down the rabbit hole a little bit. But at the same time, I'm going to pause, interject here and there to just ask some clarifying questions. I think that'd be a good time.
Today, to start off the conversation, Demetrius, we have in whole life insurance, when we're building for cash value, the whole reason we add term insurance into that policy is we're trying to get the death benefit high enough to justify the amount of premium that you want to pay. Because remember, the insurance company tells us the minimum amount of premium we have to pay, and the IRS tells us the ceiling of what we can pay. That calculation about how much premium we can put in is really based around the death benefit. So if we take a step back and understand that if we get the death benefit high by using term insurance, which is categorically cheaper than whole life, more of our dollars can go toward building cash value. And so we've got three main types of term insurance riders. I'll list them out and then we can ask any specific questions.
Can I actually interject before we get into that?
Yeah, go for it.
So here's a question that comes to my mind that I just feel like might be burning in the brain of somebody watching, right? One of the questions might be, dude, Alden, you're talking about getting the death benefit high, but I thought, Caleb's book and like the and asset and what you guys preach about is like get the death benefit as low as possible. So where does this all fit?
Demetrius, that's a fantastic question. So what we're doing is we're inflating the death benefit artificially with term insurance to justify the amount of premium that you want to pay. So said another way, if you come to the table and you say, hey, I want to pay 10 grand a year, I'm going to make the death benefit on the policy as small as I can to justify $10,000 of premium. That death benefit could be purchased by $2,000 out of the 10 that we're paying. But to get the total of 10 that you want into the policy, I have to build in some term insurance. So think of it as just a cheaper way to accomplish the goal of having a high enough death benefit to then allow us to put in a lot of extra capital towards cash value.
That was very well said, dude, especially when it comes to the high enough. And I think a lot of people kind of do that, the chef kiss right there. But I think a lot of people would love the fact that it's like, hey, I get it. And it's a matter of like probably getting out of this whole, I don't want my policy to become quote unquote taxable, right? The whole MEC rule and all of that. So we don't have to go down that rabbit hole, and we will not today, at least not too much. But anyways, you can keep going forth.
So the three different types of term insurance riders that we build into whole life insurance are as follows. Level term. This is quite simply term insurance, a set amount for a set period of time, and then it goes away. We then have annual renewable term insurance, similar concept, level death benefit, but the cost of that coverage increases every single year. And then the third type is a hybrid, or it's also called blended term insurance. And what this does is it blends term insurance with another rider that everyone on this channel should be familiar with, which is paid up additions. When these get blended together, we have the ability to put money into this rider and have it also show up in cash value over time. So it's not a pure cost as far as term insurance goes. So those are the three that we're going to dive into today. And what I'd like to put in the minds of everyone watching today is really which rider is the best? Now, if you're going to come talk to me about insurance or come talk to Demetrius, we're not going to be able to answer that question because your situation is what tells us what's the best fit for you. But the reason I want to put that question in your mind is because these riders exist for a reason. Every company and every carrier has a different product and a different way for our team to pull those levers to make it customized to you. So the way that you see the world, the way that you see your situation, as we talk about how these term riders affect the policies, may be a great way for you to initiate a conversation with us down the road. Hey, I saw this video. This term rider makes a lot of sense, I think, for the way I want to fund. Can you help me? And so click the link below if you do want to have a conversation about this after this video, and we'd be glad to talk to you.
So Alden, there's like a few different types of, like, very generally speaking, there's a few different types of policies that we tend to design. And so we're going to go through a few of those. I believe you got those ready to kind of talk about and such. One of them is a cash flow policy where we're going to be funding that thing for a really long time. Another one is a front-loaded policy that we're also going to be funding for a really long time. And then we're going to show a front load where we're showing it for a funding period of short. So let me quickly define for those who, maybe you're new to the channel or something like that. What do I mean by cash flow versus front load? Cash flow, the way that I like to simplify it is that the amount of cash that you're putting into that policy for that first year is going to pretty much remain steady from year to year to year. So for example, $15,000 a year, that's what you're putting into the policy every single year. That's what we'll illustrate. And then front load means like, hey, I'm sitting on a little bit of cash. I really want to reposition money from where it is into life insurance. Say, for example, sitting on 40 grand, throw 40 grand, 50 grand into a policy, and then 15 grand a year after that. So front load is nothing more than a cash flow policy with a larger injection of cash in the first year.
Really good definition. So for our audience, I'm going to break that down slightly a little bit more. Cash flow and then front load. We have a definition of cash flow and front load. So what I want to do is up on your screen, you're going to see which one of these is going to excel in which areas. So first of all, front loading. The way that we build these types of policies, we're going to have a high degree of cash value in the very first year. It's likely going to break even sooner. And then the downside could be the long-term efficiency of growth in that policy is going to be affected because we're having to buy more insurance to justify that first year of front-loaded premium. Then we have cash flow on this other side. Cash flow will excel at long-term performance and efficiency. We're going to have a slightly smaller amount of cash value initially in the first year because we're not front-loading the contract. And the con is that, again, we don't have as much cash value as we may want in the very first year. Now, there's a wild card I'm going to throw in here, and this is highly situational, but in some circumstances, front loads are going to give us a drop in death benefit in the future. And for a lot of our clients, they don't like that. So cash flow, front load, anywhere in between, we have some levers we can pull to try to get this to be as optimal for your situation. But in general, those points that I just highlighted are the main differences here. So to go into some specific examples, we're going to talk about this first example of a cash flow design for a long period of time. So the period of time is 30 years. And the premium that we're going to be paying is $15,000 per year. Now, this policy, technically, we have the ability to fund shorter, longer. We could put in a little bit more. We could put in less. But because we're looking at a stagnant point in time and we're illustrating the purpose of term insurance, we're going to be talking about this as if this premium is paid to the T every year and dividends don't change for the next 30 years. Don't come back and tell me this didn't work 30 years from now because I realize that. I know. To illustrate a point. All right, here we go. The first one I want to talk about is level. So level term, as I mentioned, is for a set period of time. If we're going to build a policy to overfund with a large degree of extra premium going into paid up additions, we need to have a level term insurance rider on that policy for the amount of time we want to overfund. So in this example, we're looking at 30 years. All right, so jumping right in here, we've got a contract premium of $15,000 per year. And what we can see with this type of rider, if we're doing level term, and this likely is going to give us a solid amount of cash value in the very first year. After we pay $15,000 of premium, we have $13,310 of cash value at the end of that first year. So this gives us a good amount of liquidity. The first year death benefit is $264,637. Now, one of the things I mentioned earlier is if we're going to be building a policy with this kind of term rider on it, we have to keep that term rider on the policy for as long as we are overfunding it. Otherwise, if we drop the death benefit too soon, the policy could become a modified endowment contract. So we've got 30 years of funding at $15,000. And what I want to highlight for us is what the cash value is and the death benefit is after 30 years of funding. So in year 30, cash value is projected at $844,400, and the death benefit is projected at $1,432,156. So as we see these numbers on your screen, we're going to continue to reference them as we look at the other examples of using the same kind of funding, but switching up the term insurance. Any questions from you, Demetrius, so far?
No questions, Alden, but I do have a comment. I just wanted to share that when we're building a policy just like this, Alden, you kind of referenced it earlier, I believe, but at the same time, just wanted to reiterate the fact that although we're showing 15 grand for a total of 30 years, there is flexibility in terms of, the minimum premium versus the maximum premium. And so as life happens, your premiums that you're contributing can also ebb and flow as well.
That's right. That's absolutely right. So lots of flexibility. We're illustrating this in a vacuum to kind of show the point of the term insurance, but no policy, if it's structured correctly, is going to lock you into a premium you have to pay at 15 grand every year. We got to have that flexibility in it. That really helps. So jumping on into annual renewable term. Annual renewable term, just to recap, we have an increasing cost of term coverage every single year. Now, the majority of the carriers out there that have annual renewable term on their policies, they're designed to actually decrease the amount of term that you're purchasing every year. Well, how do they do that? They do it based on how much permanent insurance is being added to the policy over time. So if we go back and we remember, Demetrius, what do paid up additions actually do? Can you explain that to our audience here?
So paid up additions, the simple way of putting it is that it's one of the main drivers within these types of policy structures that increase your cash value and give you a high level of liquidity. So that's the cash value side of it. But more from a life insurance perspective, what it's doing is buying little amounts of permanent, fully paid for death benefit as well.
Perfect. So in that example, we can say the permanent death benefit that's being purchased by extra premium going into paid up additions, or by the dividend coming back into the policy to buy extra premiums, which would be paid up additions, that's going to increase our permanent death benefit coverage over time. So annual renewable term is going to give us a level death benefit day one. It's going to be fairly high. And over time, that term is going to drop, and then we're going to have an increasing amount of permanent insurance to maintain level death benefit until we're no longer funding that term insurance rider over time.
So I have a question. So the question is it safe to assume, or is it just a little bit too far of an assumption to say that if you have a level term rider, initially you're going to notice that death benefit starts to rise and rise and rise over time, but with annual renewable term, it's keeping your death benefit the same from day one? Is that a fair? Okay, awesome.
Yep, absolutely fair. Level term, because we're guaranteeing a certain amount and then we're adding more death benefit on top, it'll grow with your policy. And then we'll have a big drop in the future when the term expires. Annual renewable, because of this give and take, it's going to be level from day one. So when we start looking at policy values, it's the same $15,000 a year premium. Our initial end of year value is $11,565, but our year one death benefit is $1.5 million, down to, after 30 years of funding, net cash value at that time is projected to be $764,985. The death benefit at that time is $1.5 million. So we have this give and take that's happening for 30 years. You don't lose any aspect of death benefit coverage, but you don't gain any either, because we're replacing term insurance. Now, when we're going to come back to compare all three of these, we're going to see the effect of having a term insurance rider that increases in cost. It's one of the reasons that we don't often use annual renewable term for long-term funding strategies, but I think you'll see my point here in a couple minutes. So Demetrius, if we're ready, we'll make a bit of a pivot over to the blended term insurance rider.
Let's do it.
Blended term insurance, to recap, it's a blend between pure term and paid up additions rider. There's some other nuances, and I try not to go into the nuances because they are carrier specific. There's 3 carriers we work with that have a blended rider. Each of them operate a little bit differently and they're described differently. So in general, term, paid up additions, wha-bam. Okay. When we look at this particular policy illustration, we've got a first year cash value after $15,000 of premium. End of year value is $11,660. First year death benefit is $552,943. Over time, as we're paying into the term insurance rider, those premium payments actually start going more towards paid up additions and less towards term. So the way I describe this is think of this like a gas gauge, okay? So here's your gauge. All the way over on the right-hand side next to full, we have every dollar that you put into this policy is going toward term. Every year that your policy is in force, we have a little bit less of your money going toward term, a little bit more going toward paid up additions, so that eventually all the money you're paying into that term rider actually shows up in paid up additions towards cash value. So it's a very efficient long-term vehicle. And I think you'll notice that when I give you the highlighted numbers here.
So it's almost like this blended term is a way to have your term insurance purchase paid up additions, which result in higher cash value. I'm not saying it's a perfect science, but that's a way of thinking about it, right?
Yeah, it's like you have your cake and you eat it too. You know, it's doing both things for you, which is fantastic.
Like that.
So out here, 30 years in the future, cash value $1,038,534. Death benefit $1,857,574. So if you look at these numbers up on your screen, we've got at the top our level term that we went over first. We then have our annual renewable term contract. Now we have our blended term insurance. Out of these three, from a cash value perspective, some of them, such as the level term, may have a higher early cash value. However, long-term performance, because of the fact that the money you're putting towards term insurance ultimately does show up in cash value over time, blended insurance is going to be the best long-term strategy for this type of funding. Does that make sense?
So Alden, as we went through all of those, one thought that came to my mind is the fact that there's a lot of values on the screen. We're showing first year, we're showing 30 years down the line, we've got the death benefit and all of this. But I think more important than anything is what you value most, right? And so if you're wanting to utilize your cash value early on and things of that nature, a lot of times it could make some sense to perhaps, maybe, level term could make more sense. But if you're like, dude, I want this because of something happening in 25, 30 years from now, blended term could probably make a little bit more sense. It's like, none of this is financial advice, and I'm not wanting to tell folks that they should do X or Y or Z. And at the same time, it helps to kind of think through values, no pun intended, when we're looking at cash value and such.
Absolutely. So the really good point that Demetrius just made is your needs coming into the call, ultimately going through our process, tells us the type of policy that may be best fit for you to help you achieve your goals, right? So even though cash value wise, blended term is going to kick everybody else's butt, I didn't have all that death benefit from day one like I did with annual renewable term. We can't over or under stress the benefit of having permanent life insurance coverage from day 1 to day 30. And the amount of coverage that you carry can be a very important aspect of the conversation. We're always going to encourage you to really evaluate what your family needs in the event of your passing. So the death benefit still has a big part of the conversation.
Well said.
As we pivot, now we're going to be looking at a front load with a long pay, $50,000 in year one, and then $15,000 per year all the way out for 30 years yet again. So some of the things that have not changed is we're still using a 30-year level term rider. I'm still leaving annual renewable term on the insurance policy for a full 30 years. And our blended term now just has more insurance to justify putting in that $50,000 in the very first year. So what we're going to notice right away, looking at the level term insurance, we've got an early cash value of over 90% in the first year. Your cash value is $45,940. End of year death benefit, $826,465. We go out long term, we've got at the end of 30 years, $908,831 in cash value. And then the death benefit, we have $1,981,891 in death benefit. So this still generates a large degree of liquidity. We've got over double or very close to double what you put in premium is available to you at the end of that 30-year period, generating a lot of cash value. Now we're going to jump into a couple of the other designs to see, could this make more sense if we did a different type of term insurance rider? All right, so jumping into the annual renewable term insurance. First year, we still have a high degree of cash value because term insurance, if we're only buying it technically for a year, is wicked cheap. So because of that, we have a high degree of cash value the first year, very similar to the level term. Over 90%, $45,149 in cash value, and a level $1.8 million death benefit that will remain that level all the way out for 30 years. Because remember, We got this give and take going on. You buy more insurance, they give you less term over time. Looking down at year 30, we've got cash value of $860,014. Death benefit is that $1.8 million number still. So Demetrius, between these two numbers that we've looked at, what did you notice as far as the cash value at the end of this 30-year period? Which one is going to be a higher cash value for us?
The level term. If I'm looking at the numbers right, it looks like the level term.
Exactly. Level term, 908, almost 909 in cash value. And then over here on the annual renewable term is 860,000. The biggest reason for this, ladies and gentlemen, is we have an increasing cost of insurance. Every single year you're alive, your cost to buy term insurance, even though that amount is shrinking, is going up. This is providing a drag against the policy's performance from a cash value perspective. Now, on the other hand, we've got a $1.8 million of death benefit from day one to day, whatever, how many days between now and 30 years in the future. So that is a huge benefit that I think should be stressed. But the cash value performance definitely lags.
And it's funny that you did say towards the very beginning of that, it's like, I think you used the words wicked cheap for the annual renewable term. And it's like, well, yeah, that's the case. So we have at that age, 36 years old, as we're seeing this today. And then 30 years down the line for a 65, 66-year-old, I mean, if you keep that 1-year term on there that long, I mean, it gets very, very expensive the older you are to, even for 1 year of term, to insure you for X amount, right?
Absolutely.
Even though we are even decreasing the total amount of term that you have in that case. And so that's where it's like, what is it that you're looking to accomplish? Is it a short-term play? Is it a long-term play? And that really helps us to determine which direction we should head from a standpoint of the type of policy, the type of term rider that we end up going with. Does that make sense?
Absolutely. Absolutely. And you bring up a good point. When it comes to annual renewable term, that is a risk in the policy. Increasing cost of insurance is a risk. If you pay less than you intend from day one, your policy costs are going to be higher because you have more term that you need to buy to maintain a death benefit. I'm not going to get into the details, but this is one of the reasons that universal life products can be so dangerous, is that are built on a term chassis that increases in cost every single year on your life. If you don't pay enough premium, or your policy doesn't get the returns that are projected to outpace the increase in cost of insurance, you can find yourself with a lapsed policy or in a lot of trouble in the future. So not a bash against IULs per se, or universal life policies per se, but it's just like this product we're talking about with whole life. If there's an increase in cost every year in the policy, you have to be very careful with the strategy of how you're using it to understand it fully, to make sure you don't find yourself in a lot of trouble in 20 years.
Right. Especially if you don't want to have to pay into it for longer than anticipated. Right.
Yeah. Absolutely. Third and final, Demetrius, I want to just let you take a guess on whether this policy is going to outperform long-term than the other two policies we've looked at, the new type of term insurance rider we're looking at, which is blended term.
I'm going to say it's going to outperform. I think it's going to outperform for sure.
Let's see what we're looking at here. So year one, $50,000 of premium. End of year cash value, $41,723. First year death benefit, $1,289,934. Moment of truth, year 30, we have cash value of $1,140,868. Total death benefit, $2,171,499. You have the numbers on your screen, but I'll spell it out to you real big. When it comes to blended term insurance, because of the benefit of also creating cash value over time, it is going to be more efficient long-term. You're sacrificing early cash value. Your first year cash value is not going to be as strong as the other cash value options that we have available on the market because of the different type of term insurance. Demetrius, you want to say anything?
Yeah. And so one other thought I'll have about that too is the fact that, sometimes when it comes to folks who want to utilize their cash value and probably want to use a good amount of it early on, I mean, that's a consideration to take into effect. But then I would say, Alden, feel free to just tell me if I'm off base here, but most of the people that we're working with on a day-to-day basis typically do not need or even want to have access to all of their cash value because it's not really necessary. And so if you're looking at it from a standpoint is what is the value that I have long term, and you tend to have that sort of a mind of frank frame of thinking, perhaps blended term could give you the greatest bang for your buck, if you will.
Absolutely. I think from a long-term performance perspective, blended term on a policy that's designed like this is going to be far more competitive long-term because of the ratios of where your dollars are going over time. But again, we have to know what we're giving up if we choose this type of option. we're giving up approximately 10% more in cash value in the very first year. And if you're putting in hundreds of thousands of dollars, that could be a lot of money. So it could be something to really dissuade people from doing blended term, because we do have less cash value, usually closer to 75 to 80% cash value the first year with blended term, depending upon the size of front load. And then additionally, the death benefit is going to be lower than some of the other options. The annual renewable term option death benefit was $1.8 million from day one all the way out 30 years into the future. From a protection standpoint, when people come through my calendar and we talk about a policy that's using this type of blended insurance, if that $1.3 million death benefit is not adequate, we're looking at a separate term insurance policy. And we have to weigh the cost of that if we're doing an apples to apples comparison. So not always the best solution for everybody, but it does, I think, paint a very clear picture as far as efficiency and your dollars in a policy are concerned for cash value and ultimate death benefit growth.
Can I throw one other thing out there? It's like, I don't want to be misconstrued with saying that everyone should get some sort of a blended term whole life insurance policy because of the long-term efficiency that you'll experience. Because you get other people who are, I would call them value creators in this world, who are like, dude, I couldn't care less. I could care less about the long-term efficiency. I want my cash up front so that I can then utilize that cash and go create more cash flow for myself and my family and things of that nature. So it's all about having a conversation up front that you and I would have with clients who come in on a daily basis. And so there's something that I thought was helpful to note as well.
Oh, you're absolutely right. But Demetrius, if you're ready, we can look at the short pay option, putting in $100,000 and then coming back with $30,000 a year for 10 years to kind of see where we land.
Yeah, let's take a look.
All right. So back on the table, level term, $100,000 year one, $30,000 per year. Year one cash value is almost 92%. We've got $91,791. Year one death benefit is $1,617,088. For this particular parallel, I'm going to actually throw in a third comparison. So we're going to go out to year 10 and we're going to look at year 10's values after funding is completed for that year to see how the policies stack up in the short term. And then we'll look at that same 30-year mark into the future. Yeah, year 10, cash value is $427,253. Death benefit is $2,215,891 beans.
Beans. Okay.
Beans, huh? Yes. All right. Now, it's important to note, we stopped funding this after 10 years. No more premiums being put into this policy. What I'm doing with each one of these policies is called an offset. The policy is now going to pay for itself moving forward. The other option out there for this type of insurance is a reduced paid up option. But the problem is when we're overfunding a life insurance contract to put in a lot of extra premium, doing a reduced paid up option may actually mech the contract because no more premiums are being paid. Just to make all things equal, I made an offset on each of these designs. Out 30 years, $969,376 for the cash value. Death benefit is $1,439,559. So we do have a drop in death benefit from year 1 to year 30 because we lose all that term insurance after 10 years. The policy loses death benefit, and now we're just running with an increasing cash value, increasing dividend, really buying more death benefit through those dividends paid up additions and increasing the death benefit over time. But we do still see a hit even over a 30-year trajectory. You ready to jump into annual renewable?
Yeah, let's take a look. That'd be good.
Annual renewable term. First year, same premium as before. $100,000 the first year, $30,000 a year all the way up through year 10. First year cash value, $92,784. First year death benefit, $2,400,000. Go out 10 years, cash value is $434,115, and we still have that level death benefit at $2.4 million after a 10-year time frame. On down 30 years here, cash value, $976,635. Net death benefit is $1,717,819. So again, we do see that drop in death benefit even after a 30-year period. The term insurance drops off because we're not funding the policy anymore. And now the policy is going to continue to grow and increase that death benefit and cash value over time. First year cash value from $100,000 of premium is $83,523. First year death benefit is $2,564,214 of death benefit day one. Cash value at the end of the year 10 is $433,684. And the death benefit is sitting at $3,006,846. And our final number, the true test of efficiency, we've got after 30 years, we stopped premium funding after 10. So We've had 20 years of no payments. We have a cash value of $1,192,503. Death benefit, $2,503,611. So Demetrius, looking at all of these policies, we're seeing pretty much a trend across the board. Would you agree with that? From first year cash value?
More or less. Yeah, absolutely. So what we're seeing is just like there's a super high level of cash value availability early on when you do it this way. And then long term, there's some changes that happen.
Absolutely. Absolutely. And so when we have this policy designed the way that it is, term riders really matter. But again, death benefit also matters. How the policy functions mattered. How the flexibility in the premium, what's the minimum, what's the maximum. All these things are things we didn't cover because we're just trying to showcase term insurance. So I hope this helped you understand that these types of policies cannot be created equal at every single carrier. Every carrier's product and their term insurance rider, how their paid up additions rider works, the other options you have available to you are different between the carriers that we work with and the products that we have available.
One thing that's really helpful about kind of working with our team is the fact that we're not married to any one particular carrier, right? We don't have this one carrier that we always go with and we want to pigeonhole people into that, right? Because if we did that, it'll be like using a screwdriver to pound a nail in the wall. It's like it might get the job done, but it's not going to do it very well. It's not going to do it very efficiently. And so when we have the ability to shop the market and even show you a couple of options potentially in some situations, it's going to be better for you, right? And so we want to collaborate in order to make the best decision in collaboration with you.
Absolutely. Well, Demetrius, I had fun. I think this is good. Yeah. I think our audience really likes these types of in-depth, detailed illustrations. We're doing this editing a little bit differently, guys. So we're putting up values on the screen, not the full illustrations. Give us some feedback if that's something that you liked. Maybe it's a little bit more clean, a little bit more straightforward. If you want the illustrations back, start yelling in the comments and we'll hear you loud and clear. So let us know how we did.